Rick, you oversee about $600 billion in AUM. When you come in, first thing you look at, what is it? What tells you where this market's going?
Now, that's changed around quite a bit in the last few weeks. It used to be you'd watch where rates, where interest were, where U.S. rates were moving. You'd watch stocks when you come in the morning. You'd see what happened in Asia. Today, we focus immediately what's happened in Europe, what happened to the European stock markets, what happened to the European bond markets. We look at the CDS markets to see where sovereign risk is, but it's really the whole world's focus has shifted to Europe. And we look at the peripheral and where some of the primary focus has been recently is what's happening in Italy, what's happening in France, and today markets are better. And so you'll see a direct comparison with when those markets are better, usually it drives the equity markets, and it's usually what all risk assets and fixed income are pivoted off right now.
What is your read and your sense on how you're managing this money in the fixed income market with what's happening in Europe right now? Are you encouraged that it looks like European leaders have come together, that they finally have some sort of coordinated action plan? Do you feel that that's a long-term improvement?
It's still hard. I mean, it's. I would say if you said today versus a week ago versus 2 weeks ago, I actually feel a little bit better. The dialogue's improved. I think some of the focus around liquidity for Italy and Spain, the banking system funding, that's really come to the fore with policymakers. So I would say today versus a week ago, 2 weeks ago, I actually feel better about things coming together. It's not to say it's not still hard. There is not unified opinion about what to do and how to solve this thing. So it's going to take a little bit of time, but I would say it feels better today.
Your boss, Larry Fink, has said, you've got money managers hurting. We know that. You've got investors playing scared. How does that manifest itself in your market right now in fixed income?
Yeah, I mean, some of the primary directive today is make sure in terms of capital preservation you're not taking tremendous risk because markets can be extremely volatile. We went through a period for 4 years back in the last decade where the equity market didn't move down more than 2% in a day. Mm-hmm. Now you're getting 2, 3, 4, 5% every single day. I mean, some days you're getting it 4 or 5 times. So it impacts the fixed income market, impacts liquidity. So you've got to be really careful about where do you take risk because liquidity can be tough.
What effort on a global level do you think would be most critical right now? Maybe something that's not getting discussed? Yeah,
I mean, I think people are starting to talk about what can the ECB do and what could this new program, the EFSF, do. But I do think you're going to have more discussion about providing more of a liquidity foundation underneath Europe, and that's to help the banking system, that's to help Spain and Italy refinancing themselves. There are rumblings of that, and I think you're going to hear more and more of that over the coming weeks. In terms of where we're investing, I mean, we still like U.S. financial assets. We love parts of the high yield market, parts of the credit market, asset-backed securities. We also, in the back end of the curve, like we talk about, like municipals, like investment-grade credit. We are starting to buy in Europe some of the financials, some of the insurance companies that have gotten
very beaten down French banks.
We're buying a little bit. I mean, at the margins.
A
little bit. We're you have to be. It's there's going to be risk, and there'll continue to be risk. But there are some opportunities in Europe that we're starting to move some of our assets towards. And probably do a bit more of that if you see some stability.
You see more opportunity in Europe right now than you see risk?
I think risk is not going away probably for a few more weeks. But I think there's opportunity. When we were looking at some of the insurance companies today. Insurance companies come under tangible pressure. They have some exposure to the sovereigns. But boy, you look at their capital base, you look at they're not terribly economically cyclical. It's really attractive given certainly where they used to be.